You just lost $5,000 on a stock, so you sell it. You lock in the loss, you grab a tax deduction worth up to $3,000. And then, because you still believe in the company, you buy back in the very next day. Smart move, right? Wrong. You just vaporized your entire tax deduction. Every single dollar. Gone. And your brokerage didn't say a word. There's a hidden IRS rule that silently annihilates tax write-offs for millions of investors every single year. And by the end of this video, you'll know exactly how it works, why your brokerage won't warn you, and the simple fix that keeps your deduction alive. So let's back up. Every year, investors do something called tax loss harvesting. Sounds fancy, but the concept is simple. You sell a losing investment to lock in the loss. That loss gets subtracted from your investment gains for the year. And if your total losses are bigger than your gains, you can deduct up to $3,000 directly from your ordinary income. That is real money. If you make $75,000 a year and you harvest a $3,000 loss, the IRS taxes you as if you only made $72,000. It's one of the few legitimate tax breaks that regular everyday investors actually get. But here is where people destroy it. The IRS has something called the wash sale rule, and it says this: if you sell a security at a loss and then you buy that same security, or quote one that is quote substantially identical, within 30 days before or 30 days after the sale, your loss disappears. Poof. Gone. The IRS acts like the sale never even happened. No deduction, no write-off, nothing. And here's the part that trips people up. It's not just 30 days after the sale, it's 30 days before, too. So if you buy more shares of a stock, and then within 30 days you sell some of those shares at a loss, that's a wash sale. If you sell at a loss on a Monday and buy back in on Tuesday, wash sale. If you sell at a loss and then your automatic dividend reinvestment buys more shares 3 days later, wash sale. Let me show you how this plays out with real numbers. Say you lost $10,000 on a tech stock this year. You sell it in December to harvest the loss. You're planning to deduct $3,000 from your income this year and then carry the remaining $7,000 forward into future years. If you're in the 22% tax bracket, that $3,000 deduction saves you about $660 in actual real tax money. Not bad, right? But then, on January 2nd, you buy the same exact stock back because you still believe in it, because you think it was obviously going to bounce back. The IRS looks at this and says, nice try, wash sale. Your $10,000 loss is disallowed. Your $3,000 deduction for this year, gone. That's $660 in tax savings, gone. But it actually gets worse. The loss doesn't just vanish into thin air, it gets added to what's called the cost basis of your new shares, which means you won't actually see the benefit of that loss until you eventually sell those new shares. Could be years, could be decades. And if you never sell, you never get the deduction. That money is trapped. Here's what frustrates people the most about all of this. Your brokerage, whether that's Robinhood, Fidelity, Schwab, Vanguard, whoever it is, they know you sold at a loss. They know you bought back in. They can literally see it happening in real time on their own platform. But they will not stop you. Some of them will flag it on your tax documents after the fact. You'll see a little code on your Form 1099 in March or April, but by then, it's way too late. The damage is already done. Why? Because brokerages are not your tax advisor. They are legally not required to warn you before you make a trade. And even if they wanted to, the wash sale rule is incredibly complicated, especially when you start getting into what counts as, quote, substantially identical. Like if you sell an S&P 500 ETF from Vanguard and then buy an S&P 500 ETF from iShares the exact same day, is that substantially identical? Honestly, the IRS has never given a clear answer, which means brokerages don't want the liability of telling you one way or the other, so they stay quiet, and you pay the price. Okay, so how do you actually avoid this? There are 3 strategies that work. Strategy 1, wait. If you want to buy back the exact same security, you wait at least 31 full days after selling. That's beyond the 30-day window. Mark it on your calendar. Set a phone alert. Tie a string around your finger. Do whatever you need to do, but do not touch that buy button until day 31. Strategy 2. Buy something different but similar. If you sell a total stock market ETF, you could buy an S&P 500 ETF for those 30 days. They perform similarly enough that you stay invested and your money keeps working, but they're different enough that the wash sale rule should not apply. Then after 31 days, if you want to switch back to your original fund, you can. Strategy 3. And this is the one that catches almost everyone. Turn off automatic dividend reinvestment before you sell. If you have sold a security at a loss and you still have dividend reinvestment turned on for that same security, that tiny automatic purchase can trigger a wash sale. Even if it's just a few dollars. Even if you didn't manually do anything, people get caught by this all the time. They sell a fund, they think they're in the clear, and then 3 days later, a $12 dividend reinvestment quietly wipes out their entire harvested loss. $12? That's all it takes. So, let's recap. The wash sale rule disallows any loss on a security if you buy that same security, or something substantially identical, within 30 days before or after the sale. Your brokerage will not warn you. The IRS will not warn you. The only person who can protect your deduction is you. Wait 31 days. Buy something different in the meantime if you need to stay invested, and turn off dividend reinvestment before you sell. If this was helpful, there's more on the channel. I break down tax strategies, investing mistakes, and money topics that actually matter to people trying to build real wealth without the fluff and without the gimmicks. Stay sharp out there, and remember, 31 days.